Well, stocks opened lower on Monday morning. The market's first reaction to Friday's dismal jobs report as the markets were closed Friday for the holiday, but then stocks pared their losses, posting slight gains later in the morning. Now, the economy only added 126,000 non-farm payrolls in March, while economists were expecting 247,000. So what does this mean for the markets and the Federal Reserve's rate hike plans? Well, let's bring in Ian Weiner, head of equity trading at Wedbush Securities. And Ian, your reaction to the jobs report on Friday? Stocks seem to be shrugging it off.
Sure. I mean, the report was a disappointment across the board, and I think it's further evidence that the economy is slowing a little bit, and that the hit to crude oil is actually starting to affect hiring in across the economy. I think stocks are rallying because now you just pushed out a Fed rate hike, probably till 2016. And so as long as the liquidity continues to pump into the system, then you wind up with this massive rally. And I think you saw that reversal off the lows when people started to price in the fact that the Fed is not going to raise rates for a while.
All right, so are we back to this psychology of bad news is good news for the markets? I mean, on the one hand, you have a blemish for the economy, so you might think, well, maybe let me get out of stocks and go into cash. But on the other hand, poor economic data could delay a rate hike, and that's good for stocks. So talk to us a little bit more about the market psychology right now.
Well, the psychology has been, for the last 5 years, liquidity trumps everything. And as a result, you continue to get this argument that there's no other place you can be other than the stock market. And so the psychology continues to be, as long as that second derivative of liquidity increases, which it is, as you look at the ECB, as you look at China, Japan, and now even the US is going to be pushing out rates, it's hard to make the argument that stocks are expensive. And so that's the psychology. I think the reality is that there hasn't been a whole lot of growth anywhere, and it appears to be slowing pretty much everywhere. So those are the two forces that are kind of up against each other. And for now, investors are going with what's worked, which is to follow the liquidity.
All right. Now, there was an article in this morning's Wall Street Journal saying how the dollar's rally might not be as strong as it has been in recent months going forward. Do you agree? Give us an update on your take on the dollar.
Sure. I mean, it's hard to see how the dollar is going to go much higher near term, just because it's had such a massive move. And it's pretty clear that the U.S. economy is slowing. So for all the arguments about how rates were going to go up and why the dollar was going to continue to go to par, at least on the euro, those have kind of been put on hold, just as far as the Fed rate hikes have been put on hold. So I think ultimately we'll go to parity, probably by the end of the year, but in the near term, it's more of a consolidation of a gain than any kind of breakout to new highs right now.
And should investors be factoring that in when they're deciding on what to invest in right now, or is that more of a longer-term issue for you?
No, I think it's an issue when companies start reporting earnings in the next couple of weeks, because they're going to give guidance for the full year, and there's a real possibility now that 2015 S&P earnings are going to be below 2014 S&P earnings. So, unless you think we're just going to continue to get massive multiple expansion, and maybe we do, but unless you think that, you really got to own stories where there's significant growth, because you're just not going to get that anywhere. Otherwise, you can buy some more safety, but those dividend yields / corporate buybacks, are probably closer to the top than the bottom. So my advice is just to continue to know sort of why you're in stocks and why you own certain companies. And if it's clear, great. But if it's not, I'd advise people to step to the sidelines.
All right, Ian Weiner, head of equity trading at Wedbush Securities. Thanks so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.